Hi friends, welcome to my YouTube channel SJM Commerce Champ. Today we are going to learn about factoring. It's a firm-based financial service. There are two kinds of financial service, fee-based financial service and firm-based financial service. In fee-based financial service, only advisory services are provided, and in firm-based financial service, fund is arranged by one party for other party. Now let's see the contents. In this video, you will be learning meaning, introduction, definition, origin, what is off-balance sheet transaction, what are the parties involved, factoring charges, services offered, and advantages of factoring. What is factoring? The meaning of factoring. As I said, it's a fund-based financial service. Funds are arranged by one party for the other party. It's a financial transaction. It's an agreement between two parties where one party is selling its accounts receivable, that is nothing but the invoices, to the third party, and that third party is called as a factor at a discount. Now, how much discount is charged? 20 to 10% discount is charged. So it means 80% amount of the invoices is paid by a factor to the client immediately. Sometimes it's 90% also. So remaining 20%, whatever 20% remains, that is paid by the factor to the client after deducting his cost of operating cost, finance cost, or whatever cost is there. That is deducted from the balance 20% amount, and then it is paid back to the client. Take one example. Suppose the invoices of company A are of rupees 1 lakh. These are sold to the factor, and then factor is paying 80,000 rupees, because here we have seen generally 80% is paid by factor to the client immediately. So 80,000 is paid by factor to the client, and after that, most of the time after collection from the customers, then remaining 20% is paid by the factor to the client. So from that 20%, that is 20,000 rupees, factor will deduct his finance cost and operating cost. Suppose the finance cost and operating cost is 5,000. So from the 20,000, he will deduct 5,000 rupees, and remaining 15,000 rupees will be paid by factor to the client. So in this way, we have taken one example also here. Collection of debt from customer is done either by the factor or the client. So it depends on the agreement who is going to collect from the customers. The invoices are assigned to factor regularly for the purpose of funding, collection, and self-ledger administration. So they have that kind of agreement in which whatever invoices are there, they are supplied or assigned by the client to the factor regularly. And what factor is going to do? He is going to fund it. He is going to collect those amounts from the debtors, and then he is going to do self-ledger administration also. So all the process of collection, sending them reminders, and these kind of things are also done by the factor for the client. So here we saw what is factoring. It's a fund-based financial service. It's a transaction. There are two parties here. Then how much is paid? 80% to 90%. What about the remaining amount? From that, what is deducted? The finance and operating cost. And who collects the debt from the customers? Maybe the factor or the client. And lastly, invoices are assigned regularly, and what kind of services are provided here? Funding, collection, and sales ledger administration. We have seen this, but a short revision of parties involved. There are three parties involved: the customer, the client, and the factor. So client is going to sell the goods to the customer, and customer is going to pay, not now, but a client makes an invoice and customer is going to pay that invoice after a particular period of time. But as a client cannot wait for those longer period of time, then what he will do, he will submit that copy of invoice to the factor, and factor in return will pay 80%, at least 80% to the client. And then what factor will do after that? Factor will collect from customers that amount of the bill, and then remaining 20% he will deduct from that, and then he will pay to the client. So see, client is selling goods to the customers, and they are having the bill kind of thing between them, that is nothing but the invoice. That copy of the invoice is sent by client to the factor. In exchange of that, client gets 80% from the factor. Factor pays 80% of the bill, and then factor collects from the customers, and after collection from the customers, remaining 20% is paid to the client after deducting the charges and all. So this is the process also, and these are the parties also involved in factoring. Then what is the definition of factoring? Factoring means an arrangement. It's a financial arrangement, already we have seen, between two parties, that is a factor and his client, which includes at least two of the following services to be provided by the factor. So factor should at least provide two of these following services. Which are those services? Finance, at least he should, obviously the most important thing is finance here. So he's going to fund the invoices, and he should maintain accounts, or he should collect the debts, or he should give protection against the credit risk. So at least two services should be provided in this particular factoring, then only we can say that it's a factoring as per the factoring definition. Then what are the services offered? Along with funding, along with providing finance, follow up, collection from the receivable, from the clients of the receivables, purchase of receivable with or without recourse. Now what is this recourse? That we'll see in the next slide. Help in getting information and credit standing of the customer. So it's not only that they are just funding the invoices, they are providing information also to the client about what is the financial condition of the customers, whether credit should be given or not. And then if any sort disputes are there between buyer and seller, then those are also sorted out by the factor. So actually here why he can do all these things, factor, because that is his core business, to fund, to get the information of the credit standing of the customers. So these are this is his core business, core activities. That's why he's very expert, and he is expert in sorting the disputes also between buyer and the seller. Then we'll see how this factoring concept came into existence in the year. It came into existence in the year 1920, when at that time this particular factoring was not in the organized sector that time. So after that, what happened in 1976, Association of British Factors came in 1976. So at that time it became a proper organized sector, and after that 1989 RBI appointed CS Kalyan Sundaram committee for what, to discuss about this factoring, and then to decide about the factoring, to give recommendation about factoring in India. And this Kalyan Sundaram committee suggested to start factoring by bank through its subsidiaries. So India, it was decided that banks can provide their subsidiaries, bank can provide this factoring through their subsidiaries. So this is the chronology, that is 1920 it came into existence. In 1976 it became organized, and in India in 1989 committee was set up, and then that committee recommended to have factoring in India through subsidiaries of banks. So what happened after that in India? Banking Regulation Act was amended in 1990. We have Banking Regulation Act 1949, which was amended in 1990. So committee gave recommendation in 1989. Banking Regulation Act was amended in 1990 for what? For banks to set up the factoring services. So in India, SBI and Canara Bank, these were the two first banks in India. They set up their subsidiaries. SBI set up SBI Factors and Commercials, and Canara Bank set a subsidiary called as Can Bank Factors Limited. Both the subsidiaries are set up in 1991 to provide factoring service. So in this way, 1920 it came into existence, 1976 it became organized. This is a world scenario. In 1989 committee was set up to give recommendations. In 1990 our Banking Regulation Act was amended, and in 1991 two of the most important banks of India, SBI and Canara Bank, they set up these two subsidiaries to provide the factoring services in India. Now we'll see what are the advantages of factoring. It improves the financial discipline of the firm because it's off balance sheet finance, improves current ratio. I'm going to show you how this improves current ratio. But off balance sheet finance means what here? You have sold your invoices to the factor. That is not going to come in the balance sheet. Loan will not be shown on the liability side. That's why your current liabilities remain less and your current ratio improves. Then higher standing, credit standing. Factoring provides a large and quick boost to cash flow to pay off the liability. So they factor collects from the factor is immediately financed to the client. That's why liquidity is available with the client, so that what they can do, they can pay off their liabilities. So this will boost their credit standing. Whose credit standing? Client's credit standing. Then it improves efficiency also. It eliminates delays, Smooth flow of critical information for decision making is available. Proper credit control and self-ledger administration, credit control, all these things are provided by the factor. So in this way, they can improve their efficiency. Client can improve their efficiency. Efficiency means doing more things with the same resources. With less resources, if you are doing more, if your productivity is more, then it is called as efficiency. Then more time for functional areas. If factor is not there, then the client has to work for collection and self ledger administration. In that, they cannot concentrate properly on their core activities. So if factor is doing all these things like credit controls, sales ledger administration and all, then management can concentrate on planning, purchasing, production, research and development activities, etc. Reduction of cost. Factor is doing credit control and sales ledger, so that cost is saved on manpower, time, effort saved. So what happened for a client, it's not required to appoint people, employees to collect money to do sales ledger administration. So time and efforts are saved, and that saved money that can be used for taking suppliers prompt payment discount, quantity discount. So the same money can be used for doing other activities, so that especially for getting the prompt payment discount and quantity discount from the supplier. If supplier is happy, definitely the availability of raw material will be easily or availability will be quick, and also that is also going to have a positive impact on the business of the client. And this is nothing but the off balance sheet finance. Here you can see that current assets, inventory, receivables, 80 receivables are here. And if you are borrowing from bank, then against inventory you are borrowing 70, receivables you are borrowing, against receivable you are borrowing 50 crores. So in total your borrowings are 120, your other current liabilities are 30. Your total of the in this way you have 150 is your total net working capital. Current asset minus current liability is 50, and total current liabilities are 200. In this way, total current liabilities are 200. So original current ratio, this is without factoring. Your original current ratio is 200 by 150. So 200 by 150. So how we got this 200? 200 is your current asset, and this 150 is your current liability. This is your current liability, students. Okay, so what happens in this case, your original current ratio is 1.33 is to 1, and if you do this through factoring, then you are not borrowing against the receivables. See that that was there in the previous slide, that is receivables. Against receivable you are borrowing 50 crores, and if you are doing factoring, then you are not borrowing against receivable, so your current liability remains less. In this way, your current ratio improves. It becomes 1.58 is to 1. In this way, students, we have learned what is factoring, what is meaning, origin, services offered, all these things we have learned, advantages. So, hope the concept is clear for you. Thank you.